talking about no credit, low credit, good credit, and how that really affects you in the real estate / mortgage world. Okay. So if you can share, if you know somebody that is looking to refinance, buy, or they are looking to invest, this is the video for them. All right. So make sure I got my notes here. If you have any questions, drop them down below in the comment section, and I'll make sure that I come back and answer those questions. But I'm not going to keep you long. I want to tell you that there are some things as a loan officer, as a part of being a part of a mortgage brokerage, that allows for me to be able to do on the side versus a banker and a lender. So we're going to go into all that tonight. But let's first talk about how your credit score really impacts what you can and cannot do, right? So if we think about it, good credit. If you watch my last live, we talked about, how credit really affects what programs you can get into. Well, with good credit, you're seen as a low risk with lenders. So you are open up to more programs that are available to you, whether you are a purchaser, refinancer, or even a investor. Now, when it comes to VA, you got to be veteran or in military, okay? So you can't qualify for that, even though you might have good credit. But that's all right. You can be able, as I said, qualify for different programs. Not all programs are equal. So I'm going to go ahead and tell you that now. Sometimes you have to put more down depending on your situation with your income. But because you have good credit, you have more programs available to you, okay? That's because you're seen as low risk. Now with low credit, you're seen as high risk. Why? Because as we said before in the last live, they're looking at your past, okay? Seeing how well you have paid back your debt obligations. This matters to a lender, okay? Because you got to think they're giving you thousands, hundreds of thousands, tens of thousands of dollars, hundreds of thousands, really, for you to be able to have this investment, okay? And this is an investment. This is an investment into your future or even your cash flow, all right? Because we're thinking about wealth portfolio building here, all right? So if you're looking at it from a lender standpoint, they're thinking, okay, you are high risk. But the great thing about even with low credit, you can still qualify for some programs. So some lenders allow for you, even with as low as a 550 credit score, okay? This is usually FHA, okay? But with that program, there are some lenders that will allow for you to get a loan. And if you got a good loan officer, you can be able to get in the program with that 550 or that 580. And it's all about painting that picture to that underwriter so that they know the situation at hand and giving them everything they need so that, your past doesn't hinder you in the future. Okay. So you got to make sure, even with a low credit, there are some things that, you just got to have in place, but you can still qualify for programs. All right. No credit. I know there's some people out there. I talk to a lot of people and I find this, and this ain't, no shot at nobody. But in smaller towns, you find more people without a credit score or never even taken out anything with their credit. Well, you still have the ability to apply for a mortgage program if you wanted to buy a house or an investment property, right? You still can be able to apply. So there are lenders that do have non-traditional credit programs. So for instance, some of these lenders, if you have no credit, right? We enter it a certain way in the system. Some lenders go ahead and benchmark you at 620, which allows for you to still qualify for other programs besides just FHA. So here's the thing about this non-traditional credit. You may not have credit in your name, but you have to still have some type of payment history showcasing that you can pay back something, right? And you want it to be positive. And usually this is a minimum of 12 months. They want to see that you have been, making timely payments. This is a big thing because some of us, like I said, you rather use cash. So your credit is not necessarily, there is no credit there. There is a program for you too, boo. Okay. So don't worry. At the end of the day, if you are in a position where you don't have credit, then you want to look at what have I been paying on time for the last 12 months minimum, that can allow for me to show that I am in the positive of making payments back. Okay, because so they're going to look at that. And then the thing is, whether you have low credit, no credit, or good credit, it's still going to impact, as I said before, the loan program you can qualify for. All right, so I'm gonna give you some of these loan programs. I'm not gonna go in depth today. That's gonna be another time where we're gonna really go through these loan programs. But today I just want to give you the baseline, right? So non-QM, this is where you're not using traditional W-2 income. This can be 1099 asset qualifiers. This can be bank statements. This can be asset depletion. This can be self-employed if you're a business owner. There is so non-QM is, and this is also for those individuals that may not qualify for a traditional mortgage as well, right? You'll be sectored into that non-QM. And what that basically means is that you may not fit within that traditional parameters that usually will qualify you for a traditional loan, which is conventional or FHA. Okay. So usually non-QM, they want you at least some programs, not all, at least a 620, right? Some programs, because you are considered high, I'm not gonna say high risk, but because you're not a traditional borrower, you may need a higher credit score, like a 640 or higher, okay? When it comes to jumbo is $725,000 to date right now, okay? This is 2023, $725,000 and up, right? If you're over that loan limit, then you're gonna be jumped in on the jumbo, right? So usually with jumbo, that's millions of dollars. Like I said, 725,000. You right there at $750,000. They want you to have a pretty good score when you're qualifying for a jumbo. Usually individuals that are getting jumbos are already in the 700s, right? I would recommend being in the 700s because you're going to get a better score, even if it is a jumbo loan. All right. VA. Man, I love me some veterans and some military people. Okay. For the past 5 years or plus, okay, about 2015, 16, 17, 18, about 6 or 7, I would say. I've been working with veterans and individuals that are in the military. And let me tell you, I love VA loans. It is nothing like a VA loan, okay? Whether you are refinancing or buying. When it comes to a VA loan, you can be able to qualify for as little as 500 credit score. And if you don't have a credit, let's say you already have a house and your credit score is in the dump and you want to be able to get into a lower rate or take cash out and pay off some debt, honey, don't worry. VA got you covered. And that's what I love about VA because they take care of their military patrons, okay? And the thing about VA, you have, as I say, you got to be in the military or a spouse of someone that is in the military or used to be in the military. Sorry, kids, you don't qualify. You got to be married in or actually been in the military yourself. But what I love about VA is that you know, they understand that veterans aren't always in the best situations, and they stick by their veterans. Love doing VA loans, love them. FHA. FHA is more, you'll usually see that there's going to be more low income and middle income individuals getting loans in the FHA realm. Why? Well, number one, everybody, and this is cross board, even if you got 700, honey, sometimes FHA is better. Why? Because if you're purchasing, you can put down a lower down payment, 3.5%. Okay. And to some people, 3.5% is better than 5%, which is conventional, and we'll talk about that soon. But FHA allows for you to put less down as a purchaser. When it comes to refinancing, okay, and this is where you have a low credit score, this is where, you know, you want to go. If you are, let's say, at a 620, and this is hypothetical, okay, this is for informational purposes, do not hold my word to it. Every situation is different, okay? So, but sometimes if you have, like, let's say a 640 and you're going into an FHA program, you can possibly get a better rate. Possibly, okay? It depends on your situation. And what I like about FHA as well is that some FHA programs, when you're refinancing and you're pulling cash out, you can go upwards of 80%. And they have a higher debt to income ratio. So what that means is debt to income is how much debt do you have on and they calculate on that on a monthly basis against your income, right? Gross income. And so it does allow for you to qualify for more money whenever you want to do a cash out refinance. All right. USDA. Now, USDA guidelines, if you go to the USDA website, this is a government-backed loan. So with USDA, you can do 100% if you are purchasing. Love, love, love that, right? And USDA also got programs where some lenders allow for you to roll in your closing costs. But essentially, if you are a purchaser and you got 100% loan, you're not worried about having a down payment. That does not include closing costs. Watch the last live so you know the difference. But that doesn't include closing costs, right? But it allows for you to save more money. And the great thing about it is you can use grants, you can use different things to help you also with your closing costs and your down payments. Same thing with FHA. You can have, you can use what is called gifts to help you really pay down so you're not bringing much to the table, if anything. Usually with USDA, you have to have a minimum of a 620 credit score. And that's just like conventional, okay? Everybody wants to get in a conventional loan because nobody wants to pay, you know, mortgage insurance like you'll pay with FHA. Well, let me tell you, honey, you're still gonna have to pay. Whether you got a good credit, low credit, or no credit. Why? Because if you are purchasing or refinancing and your loan, your LTV, loan to value, is at 80% or more, then baby, you're gonna have mortgage insurance, okay? And that's a given, like regardless of your credit score. The only way out of that is paying your way out of that, having more money down where you have 80% or less. And then that allows for you to be able to save on that mortgage insurance. Usually with conventional, those programs start at 620 credit score. And the thing about conventional is the baseline, if you are a purchaser, is 5%. But now there are programs out there where you can get a conventional loan for 3%, okay? Or 3.5%, just like you will with FHA. I think right now, one of our lenders, let's say you want to do a construction, right? One of our lenders have a one closed construction loan, and conventional, and your down payment is 1%. 1%. Okay, so don't sleep. You can't sleep on these programs. You never know. And that's what I love about mortgages, because it's always a way that you can be able to help a buyer or a refinancer or an investor really get what they are looking for, but more importantly, really build your real estate portfolio. Commercial, okay, commercial and hard money. Hard money, they ain't really caring about your credit score too much. They want to know, do you have 10, 15, 20% to put down to get this money real quick? And honey, baby, you better, that money is going to be due in about 12 to 24 months, 36, but it allows for you to get in very quickly if you feel, if there are situations to where, you know, you need money right now. Hard money is more for investors. So that's why I kind of wanted to throw that in. And usually, even with some hard money lenders, they want you to have at least a 660. Okay. It depends on the program, as I said before, but all in all, hard money is like, okay, let me get in, get this property, and then I can refinance within 6 months to a year, or 24 months. It allows you to get in and fix the property up. Okay. Same thing with commercial fix and flip, buy and holds, construction, renovation. These things are under the commercial side. Some commercial lenders, what I've seen over the years is that commercial lenders are about anywhere from 640 to 660. They're starting out right there. That allows for you to get a commercial loan. Now, let me tell you, hard money in commercial is different than residential. Okay, residential is going to be jumbo, VA, FHA, USDA, and conventional. Non-QM, I know y'all probably like, whoo, girl, but listen, non-QM, let's say you want to buy a rental property, okay, and you want it in your name, you can get a residential loan to buy that rental property in your name. You don't have to go commercial. It depends on your strategy. That's going to determine if you should go straight commercial. Sometimes you got to just get in, and non-QM will be that way to help you get in. Okay. Commercial is still based on your credit score, right? Because you're the business owner, right? You can only do commercial when you have a business owner name. Some lenders do let you use your name personally, but if you don't want it on your personal credit report, then you want to go business. And commercial is the way you do that. Okay. But you want to have a great score when you go commercial, because you don't want to limit yourself in terms of what you can qualify for or have to put down because of your credit score. Okay. So let's talk about it. I'm not going to go all, but I had to really kind of like, I want you to understand non-QM, the DSCR, right? The debt service coverage. Oh, the debt service coverage ratio is what allows for you to be able to qualify for that DSCR program, right? So this is your debt servicing costs, okay? This is what it takes for you to get in here. What is the mortgage going to be versus what is that rent going to be? If you want to buy a rental property, you can go with the DSCR loan program. If you want to go strictly commercial, then you can go commercial and still get that rental property. It all depends on which one you want to go for, okay? All right, so we talked about good credit, how the lenders see it, no credit, how you can still get along with no credit, and we talked about bad credit. And each of these programs underwriter is going to base their decision on whether or not, based on the guidelines. Now, these underwriters are not just making up anything in their mind, right? They work for the lender, but there's certain guidelines that they have to follow. And if you do not meet those guidelines, then they cannot offer you that program. It's just that simple. Like, sometimes you can get exceptions, but you got to have like a lot of money or some credit. You got to be given something to get something. Okay. Usually with these loan programs. All right. So let's talk about interest rate. Man, when it comes to these interest rates right now, I mean, couple of things here, because these interest rates, they ain't no joke, right? So interest rates, people want to know, when is interest rates going to go back down? Why is interest rates going up? You know, one of the things that just came out today, I think the federal government just increased the rates by 0.25%, right? Making people freak out. They are freaking out like, oh my gosh, how am I going to qualify if you keep going up on these rates? Well, here's the thing. On the lender side, on the back office, rates change every day. And sometimes multiple times a day. Why? Because rates is not based on just the feds, it's based on the stock market. My geeky side coming out. So here's the thing. You can qualify for a rate, let's say 6%, right? You can get a 6% and you might pay $500 extra to get that 6%, but then 2 days later, everything is going great and you can get a lender credit for $500 with that 6%. So interest rate always change. They're always going up and down, right? It's up to the loan officer to really help you, loan originator, loan officer, to really help you in making sure that they understand your situation, but also when they're looking at it, they're saying, okay, let me be able to price this deal out so that I can help the borrower save as much money. And as a loan officer, and I'm speaking to you if you are a loan officer or want to be one, it ain't about the commission. It's about the person, okay? The money's gonna come, but you gotta help the person. For instance, I had a client. They had to go 9QM, right? They had horrible credit score. And when I say horrible, low. So excuse me, I'm sorry. No offense. They had a very low credit score. Their income was all over the place in terms of how they earned their income. And their situation just wasn't where they wanted to be, but they wanted to refinance to pull some cash out because they needed to pay down some debt and get some things, just cleared out. Well, they still had a score high enough to where they can get into a conventional loan. But that conventional loan, so what happened was during that time, they had a conventional loan, but then they wanted to move and get another type of loan, right? So this was years ago when they called me, helped them out then. They found me again because I allow for them to, being very transparent and telling them, hey, this is the situation, but that doesn't mean you always got to be in this situation. And that's the thing about these interest rates. You're not tied to this interest rate forever. You're not, okay? And so during that time, they needed a certain situation, able to get the money, got what they need, pay stuff down, had better credit, came back a year or so, 2 years later and refinanced. Then came back years later and purchased a house and refinanced the other house. So you're not stuck in one situation if you're trying to get in. And that's what I said, rates change all the time. Like right now, they're saying that the national average rate right now is 6.38. 6.38. Honey, is people still out here getting 6s, 5s, 4s? Okay, you can buy an interest rate. There's so many, like, you're not stuck to that interest rate. And you can refinance in as little as 6 months out of that interest rate. So don't sit here and get stuck on, is rates up, is rates down? They change all the time. So if you were to refinance and you're stuck in a, let's say you end up getting a 6.5 or a 7, can you qualify for that? If you can, then as I said, you can be able to refinance into a lower rate in as little as 6 months. Why? Because you're not tied to that interest rate. But if you're looking to really get into a home, then don't shy away just because the news and the media tell you it's at 6.83 or 7%. That's not always the case. Okay. So get in where you fit in, but most importantly, get in so you can see where you fit in. Don't just take Susie and Joe and Jim and John's opinion. You got to find out for yourself. Okay. Also, I want to point this out when it comes to interest rates. Okay. Listen to me and listen to me good. There is a difference between a bank, a lender, and a mortgage broker. I'm gonna say this again. There is a difference between a bank, a lender, and a mortgage broker. Okay? So with a banker, okay, you go to the bank. The bank has their prices already set. They might have a little time where they might can get you a couple hundreds off here or there, or they might can, do some things where you're not necessarily you rolling everything into one, but they still have certain guidelines that they do follow, right? And what you get and what they tell you you get, that's it. And they are sometimes limited on what they can offer. So for instance, not going to say the bank name or anything, because I'm not shaming nobody or giving plugs, but they don't have, for instance, a DSCR program. Never heard of it in the bank. They don't know nothing about it, right? So everything is not offered in a bank. A lender, I've worked under a lender before, not going to say their names, but the most you probably are going to get from a lender in terms of concessions is like $1,000, if that allows for you to have a little wiggle room. Lenders, they have their set prices. Yes, they're going to have more options than a banker, because that's what, whatever their specialty is, this is what they offer. But the most flexibility you ever going to get is with a mortgage brokerage. I'm telling you. Why? Because, like, for instance, me, I have access to over 100, I think like 30, 40, 50 lenders. We have a lot of lenders up under us. But that gives me the opportunity to not, keep pulling your credit score. Of course, I can pull it one time and then be able to see what lender fits best for your situation. So now I got access to the lenders in the banks as a mortgage brokerage. And so you want to be able to have flexibility and work with someone that's going to allow for you to be able to really structure a deal that fits your needs. And that's where a broker is able to do that. And what I love about having brokerage access, I get to make sure you are saving the most money, right? So the thing is, when it comes to these interest rates, as I said, you're going to pay for that interest rate. If you want to buy down an interest rate, you can buy it down. If you want to have a high interest rate so that you can save more, you can do that. If you want to have an interest rate as low as you can get it, and you're willing to pay for it, you can do that. So that comes with flexibility. Okay, so don't get tied up. I say all that to say, don't get tied up in the interest rate. All right. So I want to just leave you with this. Here's the thing about credit, credit and interest rates. Whenever my husband and I was looking to purchase a home, we were at a place where we went to an individual that worked with a lender, and they pulled the scores, and it was like, yeah, you only got one score. You have only one score with one credit bureau. It looks like some of the stuff is here, like the scores, and then you have no score, right? It was one bureau, no score, and then two bureaus. One had a high score, and then one had like a real low score. It was just all over the place. Well, our hopes was given up because they made it seem like we can afford that, like we can go house shopping. Well, no, we could not, because once we started submitting our information, we did not get approved. Went to the bank. We couldn't even buy a foreclosure. Okay. And this was bad. This is over 10 years ago. But during that time, we couldn't qualify. So we worked on getting the score right, getting savings together, and really getting our first home. When we was able to get our first home, we got a great score. I had a good score, a great rate, interest rate, right? For that first time home buyer program. Like, we used down payment assistance. We was in there, like we were ecstatic because this was our first home, and it took us probably 2 years of searching for a home and making sure we was in position to actually purchase a home. When we was able to do that, we got in, right? So during this time, we also still owned our first home. We decided to get another home. This interest rate was a little bit higher, but we had more income and we were able to qualify, right? And this is even taking into account, hey, how much the mortgage of the first home. So because it wasn't a primary residence anymore, it was a secondary, the interest rate was higher. So what we were able to do was, well, we said, okay, we're no longer living in this home, but this is our new primary. Whenever you have a primary residence, you're going to always get the best interest rate. Why? Because they know you're going to live there forever, right? At least 5 years or 2 years. It don't matter. You're going to be in the house. So it's looked at differently than if you was buying a second home, because you're not always going to be there. So the lender's taking on more risk because you're not going to be there. And now you got multiple mortgages. All of this is taken into account. And as I said, with it not being your primary, it can affect your interest rate. Well, fast forward years later, we started purchasing investment properties. So we purchased one of our investment properties. We have a private loan on it, and the interest rate on there way more than what it would be for our primary and our secondary, right? So whenever you're going into investments, your interest rate is going to be a little higher. But here's the thing that I love about investment properties. You have the ability to go interest only. Love interest only. Why? Because an interest only, you might have a 9% interest only, but on the traditional side, that's like 6%, 5.5, 6, 7, 6%, right? So you can't allow, I say all that to say, you can't allow interest rate to scare you. It's not about that. It's about having good money management, for one, but making sure you're in position to actually make the play. Okay, so let's say, for instance, if you decided you wanted to kind of do the same succession we did. First time home buyer, purchased a home, look to see how can we really get in a home for little to nothing down, right? You may be in that situation. You don't have to put 20% down. You don't have to, but if you don't want mortgage insurance and you want to go conventional, you have the score to go conventional, then totally understand why you would put 20% down. But that's not a requirement. Okay, it's not a requirement. You can put as little as 5% down. And as I said, some programs, 3%. So you got to understand your situation now and where you want to go. Because if you don't understand how am I going to make this transition, or working with a professional, mortgage professional, that's going to say, okay, let me, and I do this with all my clients, I do not play. Let me know what is your plan. Because if I know, then I can set up a strategy, not just for this one move, but we're going to make 10, 20, like we playing chess here. So, because this is how you build your real estate portfolio. You can't just concentrate on that one property. And I do have clients that say, no, I'm going to be here forever. This is it for me. So, okay, then I understand that for you, having the lowest of the low is what you're looking for, whether that is in interest rates, whether that's in closing costs, or whether that's even in your monthly payment. Like, I get it. But if you the type where say, hey, I want to be in this home, I'm going to stay here for at least 2 years, and then I'm looking to rent this out. Cool. This is what we can be able to do. Let's get you a property in a certain area where you can pull out equity. You can be able to really make an impact in your portfolio, pull that money out. You can take that money, go buy another investment property. This is how much you will need, depending on what you're looking for. Or you can go get a duplex, quadruplex, triplex, whatever it is. Then you can rent out the other units. Your mortgage is covered for. Now you got an extra income coming in. That's going to help your DTI. Now let's also, whenever, let's say a year or two pass by, you got equity. Let's pull that equity out and let's go get you another investment property. Or let's say it is your forever home. Okay, cool. This is your forever home. So now let's see where you at. Do you have enough equity in now to get a home equity line of credit? Okay, cool, you do. So let's now put this in position. So as you pay off this home, you can have that line of credit that continues to grow. Like, it's so many different ways that you can just be able to really just come up with a strategy, but you got to be willing to take the first step. Don't allow low credit, no credit, and even good credit, because they say, you know, Biden's going to now charge you. I haven't seen any changes on the back end in terms of, you know, it really affecting individuals with good credit. As I said, good credit usually gives you a good credit, good interest rate. Like, that's regardless, you know. So you can have a great credit score and be an FHA and still pay mortgage insurance. It doesn't even matter, like, whether you this score, yeah, it might be difference in terms of that percentage, but you still got mortgage insurance with good credit or low credit. So don't allow anything, don't allow what's out here in these internet streets to determine your move. Talk to a mortgage professional, talk to me, DM me, I don't care. Would love to talk to you for free. This is not no obligation. Hit me up. Like, I love talking about this because I understand this is your livelihood. People use real estate to get to the next level. You can use real estate to get to the next level. All right. So, all right, beautiful bosses, if you have any questions, if you have anything that you want to share, just drop it in the description box. I promise you, I'll be able to reach out to you. And there's also a link that is accompanied in the description where you can get access to my qualified buyer spreadsheet. for free. Just go click on it. You can play around in it. It'll tell you your monthly payments, estimate, right? Estimation of monthly payments, what that looks like in different programs that we talked about tonight. And also just informational purposes, like can I qualify for different programs, and some little links in there to kind of, you know, calculate mortgage calculators in there for you as well. All right, beautiful boss. Until next week, make sure you slay every day with style. All right, talk to you soon.